Hello, friends. This is going to be a brief video to talk about the decoupling. Now, I say brief, and I hope that it is because my other videos were very long. And I already talked about time frame continuity in the part two video, so I'm not going to go into too much, except that I am going to illustrate the power of time frame continuity using a strategy study that I wrote. Um, and so, if you haven't seen the part two video, there's a portion of that video that I would like for you to watch before you continue to watch this video, because I think it'll help to make this make a little bit more sense. So in the part two video, somewhere between the 45th minute, so about minute 45 to about minute 50, it's only about 5 minutes of video. Watch that very brief discussion right there, because that is what this strategy study illustrates. Okay. Um, so before we get into any of that, let's talk about the decoupling. Um, and before we talk about the decoupling, something that I didn't go over too much in the previous videos is the concept of a participation group. So, a participation group is sort of synonymous with time frame. It's what it says it is. It's a group of traders, a group of investors or whatever, that are participating on a particular time frame. Now think about it. For the most part, swing traders are going to be looking at a daily chart or maybe a weekly chart, right? But they're going to be using something like a daily chart to make their decision, whether it's a signal generated by a system like the strat, where we see here, for example, 2-2 reversal, right? Or whatever else, if they're using a technical indicator, or if they're trend lines or EMAs, whatever their system is, it's going to be on this chart, on the daily chart, because they have the intention to hold it over days or weeks, right? They're swing traders, so they're participating on the daily chart, or maybe the daily and the weekly chart. That's a participation group, right? For the purposes of this discussion, we are going to compartmentalize those participation groups into each chart. So the daily participation group is the group that adds to or opens or reduces positions using the information on the daily chart. And the same goes for all the other different time frames, right? Why is that important? Well, for example, we know that the monthly and the quarterly and the yearly represents the institutional group, because they're moving massive amounts of volume into and out of a stock, and when they do that on smaller time frames, it does move the direction. It changes the direction of the price very quickly, and with a lot of volatility. There's a lot of range. So they don't necessarily always want to do that. Sometimes they want to take their time getting in and moving out, and they'll use tools like dark pool and other things like that, because they only want to move the stock so much. They want the rest of the participants to also join in and move the price, and that generates better alpha for them. So when a participation group, like an institutional group, starts to trade on the daily, or maybe the weekly, or even lower than the daily, you're going to see increased range, increased volatility, and the price moves are going to be a little bit more violent, right? Um, Now let's talk about the intraday groups. In the intraday groups, depending on who's doing what, if you're trading, for example, like James Bradley does, you might be looking at the 1 minute, scalping on the 1 minute candles, or if it's a 3 minute. Everybody has their favorite time frames that they use, right? And most traders only look at that one chart. They only look at that one time frame. They may glance at the other ones, but they're participating on that time frame. They're participating on that chart using those signals. So again, each participation group, each time frame, is going to be represented by a participation group. Hopefully that wasn't too confusing. Now, the decoupling is the first time that we have a different open for all of the different time frames that we're using. So let's go up to the monthly, right? In this chart, like in the other overlay chart, this is a 1 hour chart. So the candles are 1 hour, and each one of those overlays is a day. Each one of those overlays is a week, and then the largest one is the month. Okay. So when this month opened, right there. See that red line? That's the open for that month. Each one of those time frames has a red or a green line. That's the open for that time frame. If we were looking at a daily chart, we would see a green candle, a green candle, a red candle, and so on and so forth. If we were looking at a weekly chart, we'd see a red candle, a green candle, right? And the monthly would be red. So when this opens right here, that's the same open for that month and for that day. So we don't have separate opens for the monthly and the daily. So we know if price goes below it that they're selling it today and they might be selling it this month, right? But like we saw on the example that I posted in Facebook, they could be buying it up today, they could be buying it up this hour, but the monthly participation group, which is actually the one that matters the most because they're going to be pumping the most volume in and out of the thing, was selling, and that was reflected by the fact that it didn't last very long. Let me see if I have that chart here. No, I don't. But it didn't last very long. That little rally didn't last very long, and then it went and made a three on the monthly. And at some point before that happened, there was full time frame continuity to the downside. So we would like to have. We don't have to have, but we would like to have a different open for each time frame so that we can tell, they're selling it this month? Are they selling it today? Are they selling it this week? Are they selling it right now? Right? So we don't know that until we have a different open. That's a decoupling. The first time that there is a separate, distinct open for each one of the time frames, now we have more quantitative information about who's doing the buying or the selling and when. And if they're all doing it, for example, if it's which we don't have here, but if the yearly candle, the monthly candle, the weekly, the daily, and all the intraday candles, if they're all green, that means they're buying it up this year, buying it up this month, buying it up this week, buying it up today. You get the idea. So let's look at how that kind of carries over from one chart to the next. This year, it's red. Okay, so it started up here. That's the open, and then it moved down from the open, went as far as there, and now has left behind this big wick. But it still hasn't gotten over the yearly open. On the monthly, though, it's green, and there was a little bit of selling, came back up. Right, I think it took out the low, so that's went three, a month that was two down that went three on Nvidia, and so far is a green candle on the monthly. That is also what we see on the weekly. The last couple of weeks, see, they sold it down a little bit, then they maybe sold it down a little bit last week, and this week they kept buying. They kept buying it last week, buying it this week, and then we see this rally here on the daily, where we could have gotten that 2-1, the 2-2 reversal back up, and that's what left behind the wick, and that's what was happening after the triangle day out, right? So if we want to know where the opens are on these flex grids, we'd actually have to go and draw a line for each one of those opens, for each one of those candles. And you'd have a mess of lines and whatnot. So that's why I made this overlay chart, which draws those lines for me. But not only that, I have a time frame continuity study that tells me where the highest and the lowest open is at any given time by a magenta or a cyan line. Let's go back to this flex grid again. Remember, for there to be full time frame continuity, they all have to be the same color, which means they all have to be either above it or below, above or below their respective opens. Okay. Now, if there's going to be full time frame continuity to the upside, then every time there's a new candle on the daily, it has to continue to go up. Okay. And every time there's a new candle on the weekly, it has to continue to go above its open. So at any given moment, the beginning of full time frame continuity is the highest open across all time frames. In this case here, it went below the monthly, it went below the weekly there, a little bit of conflict, and right there, at that moment, right there, that month, that hour, it's below the monthly, below the weekly, below the daily, below the hourly. We have a decoupling, and it continues lower, right? And so that's the decoupling. That's the first time we have quantitative information that every participation group is selling it. They're selling it this month, this week, today, this hour. Okay. Now, like I said, the decoupling is the first time that you have a separate open, but that's not necessarily where we would want to enter the trade, right? For example, here we had a two up, two down. The moment this went two down, and it did a little bit of corrective activity and didn't make it above what was then the new monthly open and the new daily open, and continued to go south and confirmed not only the two down, but now there's continuity to the downside. We could have started the trade there. Sure, we didn't have a decoupling because, for example, we were sharing a daily and a weekly open, right? But we did have enough information to make the trade. So in this case, here we have the same open for the daily, which is as the monthly, right? And there's the weekly open, right? Um, and here we have a monthly open, a daily open, a weekly open, and but the daily and the hour, that first hour, are going to be the same. So we don't have a new open for the hour. We have to wait for the second hour. So it wasn't until Monday, Tuesday, Wednesday, Thursday on the second hour that we actually had a decoupling. And that decoupling in particular didn't tell us too much because there was conflict, right? We knew they were buying it up. Who was buying it up? Anybody trading on the hour or lower, right? They were buying it up, but they weren't enough. There wasn't enough buying to overcome whoever was trading on the weekly and the monthly that was bringing the stock down and continued to bring the stock down for the next, 1, 2, 3 weeks until that low right there. Okay. So that's what happens when the first day of the week is not the first day of the month. Let's look at what happens when the first day of the week is the first day of the month. So here we have a Monday, and we have a weekly open, a monthly open, a daily open. That hour, they're all the same open. Notice it goes above it, right? So at least intraday, there were people buying it, right? It didn't last too long during the day. It made a high and then came back. The next day, we have this next open right here. Now we have a different open for the daily, but the monthly and the weekly are the same. Okay, so we don't know yet whether it's the monthly participation group or the weekly participation group that is bringing the price down. But we do know that we're below the daily and we're below the hourly. So, and there's full time frame continuity to the downside. We just don't have a decoupling yet. It's not until where do we have a different open for the week, the following week. Okay, but we don't have a separate open for a daily and a weekly, do we? Until the Tuesday of the following week. But even then, we have to wait for the second hour. There goes my dogs again. Of that week of that Tuesday for there to be a decoupling. So when the last day of the month falls on a Friday, when the first day of the month falls on a Monday, we don't have a decoupling until the second hour of the following Tuesday. Okay, that's the only time when that happens. The rest of the time, we'll have a decoupling when we have four different opens, like we just discussed. Okay. I hope that wasn't too confusing, but that's basically what a decoupling is. It's the first time there's four different open. There's a different open for each one of the time frames, and we have separated the participation groups into their respective time frames, and we know whether they're buying it on the monthly, the weekly, the daily, whatever. Okay. Now let's go back to that discussion on time frame continuity. In that video, between that minute 45 to minute 50, I said that it is impossible for there to be a prolonged move to the upside and for there not to be full time frame continuity to the upside because it has to continue to go above the highest open. And each new open on a daily or weekly or hourly or whatever is going to be higher than the next, right? Unless there's conflict. So using that idea, using the fact that full time frame continuity all to the upside always begins at the highest open at any given time, and full time frame continuity to the downside always begins at the lowest open at any given time. Using that idea, I designed this strategy study that you see here, and this just proves that it will always work. So what this strategy does is it buys to open when the first time that there is full time frame continuity now, but there wasn't in the previous interval, and it sells to close the first time that there's full time frame continuity in the opposite direction now, but there wasn't in the previous interval. And it calculates that using the highest and lowest opens. Okay. So in this example, let's go back some. and let's look at each one of those trades, and look at the beauty of full time frame continuity as we use those parameters to enter or exit a trade. Let me see how I can. Let's go over here. Now, notice we have a monthly flip, and there's conflict here, and there's going to be chop, right? So there's like buy to open. Let's zoom in there. Buy to open, sell to close, all kind of within proximity of each other. Okay. Oh, gosh, keeps getting away from it. There, come down. There we go. Okay, so over here, this is the first time there's full time frame continuity. It's above the highest opens, or which is there. Okay, but it didn't do that anywhere until then. So that's where it opens the trade. Okay, there's a pullback, but then it continues. It doesn't take out. It doesn't take out the trade because full time frame continuity to the downside is right here. It actually just ticked it, but it didn't go the other way. It didn't go across it to the downside, right? So you're still in the trade here, okay? Now, granted, there's a pretty significant range here compared to like these previous days. So if you bought there and that moved like that against you, we're talking about from 201.52 down to 194 something, 78. Okay, that's about $6 against you, depending on how many shares you opened, at that first buy. You may be in trouble there, and by the time, if it did go the other way and make full time frame continuity and you got stopped out there, using those criteria, you would have had a pretty significant loss if you had anything more than, I don't know, 10 shares or something, right? But it didn't happen. So let's look at when was there full time frame continuity to the downside. Remember, I said for there to be any significant move to the upside, it has to have full time frame continuity to the upside. So that's continuing to happen as we continue to go above each new hour, and that hour is above the daily and the weekly and the monthly, and that continues to happen. There. There's no full time frame continuity to the downside until right there, which coincides with a monthly flip. Okay, now look at what happens next. Buys there, and it sells there. Because it's a flip, there's still time frame continuity. I mean, there's still some consolidation up here. There was some exhaustion risk. Anytime you see a big move like this, you're going to see, this type of consolidative activity. And it's a new month and whatnot. So there's a lot of these entries that are not profitable like that. But notice that in this example, it's only going to be buying long and selling, to close that trade. It's not in a trade anymore, and that was a substantial amount of profit right there. It's no longer in the trade once there's no longer once there's full time frame continuity to the downside. It did there was a fake out, but after that, no trade until the next time there's full time frame continuity. There was a shakeout right there, took you out there on the next flip. So it's not perfect, but like I said, you won't be in the trade for a significant period of time if it takes you out at full time frame continuity to the downside. But you will be in the trade for a significant period of time if it puts you in the trade when there's full time frame continuity to the upside and keeps you in it until there's full time frame continuity to the downside, which is from there where we just saw all the way up to, look at that, beautiful trade. And it's still in it, I think, isn't it? Let's see. Zoom out right there. Yeah, it's still in it. You would have bought it there, full time frame continuity to the upside, and still be in the trade. So, not holding through any of this loss in the trade when there's full time frame continuity to the upside. But even before that happened, we already had other quantitative evidence that there was going to be a change in control, that there was going to be a change in direction, because on this on this weekly flip, it went above its open on the daily, on the weekly, and the moment and it coincided with a two reversal up, right? And so once it went above the open on the monthly, sure, it pulled back a little, but once it continued and stayed above the open, boom, you're in a winning trade. Okay. um let's look at, and but notice in this strategy study, it's actually taking the trade at the open, so it's kind of deficient in that sense. First, because there's times when there's going to be chop, but again, it's not going to keep you in it for very long if it goes the other way. And second, because it's not actually opening, it's not actually reporting there, it's reporting there. But if we zoomed out and we looked at the report, well, first of all, look at the P&L. All right, right there, when there's full time frame continuity down, sure, it was a little bit of a fake out and everything, but you weren't in there. If you're alongside, if you trade to the long side, you weren't in any of that mess. Okay. You maybe got a little bit there and you made a little money, lost a little, made a little money, lost a little. But again, once it started to pull back hard and there was FTC down, you were no longer in the trade at that point. Okay. So this isn't the end all be all. This is not the holy grail, but it's a very, very powerful part of the strat because it's one of the most important, it's a universal truth. If they're selling it on every time frame, then it's going to be moving down. It's impossible for it not to, and vice versa. Let's look at the report. Where's the report? And you'll see. I mean, there were some losing trades. One, two, three, four. Okay. Let's see. One, two, three, four. One, two, three, four, five, six, seven, eight trades. One, two, three, four, five, six, seven, eight, nine, 10. Sorry, 10. And one, two, three, four. 60% win rate. Okay. But look at the P&Ls. Now, again, this is not exactly accurate because of the things that we just talked about, but the big trades, those were those you were in that trade. Okay. And I think this has gone long enough. I hope this explains the decoupling and the power of time frame continuity. And if you have any questions, leave them in the comments.